Warning disclaimer. Nothing contained in this report constitutes legal, medical, financial, or official advice. News is news, not legal, financial, or medical advice. Do not treat the following anecdotal stories as advice. All information presented is for informational and entertainment purposes only. Always consult a qualified professional before making any financial, legal, or medical decisions. Finance News Daily Report. May 3, 2026 Sunday edition. Publication date, Sunday, May 3, 2026 covers market activity through Friday, May 2, 2026. Report type, Daily Finance Briefing audience, general investors and finance enthusiasts. 10 topics, 7 subtopics, comprehensive market coverage. Topic 1, S&P 500 and Nasdaq Composite hit new all-time highs. On Friday, May 2, 2026, the S&P 500 rose 0.29% and the Nasdaq Composite climbed 0.89%, with both indexes reaching new all-time intraday and closing highs. The broad-based rally marked a continuation of one of the most powerful bull runs in modern market history, propelled by a convergence of strong corporate earnings and persistent investor enthusiasm for technology and artificial intelligence themes. In contrast, the Dow Jones Industrial Average slipped 152.87 points, or 0.31%, weighed down by lagging industrial and healthcare names that failed to keep pace with growth-oriented sectors. The Dow has crossed the historic 50,000 milestone, while the Nasdaq has surpassed 24,000, reflecting the sheer magnitude of the multi-year rally in U.S. equities. Remarkably, the S&P 500 has now rallied at least 16% in 6 of the last 7 calendar years, a feat that underscores both the durability and the breadth of the current expansion. Investors have continued to pile into risk assets, buoyed by a combination of moderate monetary policy, robust consumer spending, and the transformative promise of artificial intelligence across multiple industries. Strong earnings from the Magnificent Seven megacap technology companies Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla were the primary catalysts fueling the latest leg of the rally. Each of these companies delivered quarterly results that met or exceeded Wall Street expectations, reinforcing confidence that the AI-driven investment cycle has durable fundamentals underpinning it rather than mere speculative hype. Bank of America strategist Nigel Tupper cited the strong global earnings cycle as a key support pillar for continued equity market strength, arguing that corporate profitability remains healthy across both developed and emerging markets. The breadth of the earnings strength is notable. While technology dominated the headlines, financials and consumer discretionary sectors also contributed meaningfully to the upside. Market participants appear increasingly comfortable with the idea that the bull market still has room to run, even as valuations stretch further into historically elevated territory. The overall tone across trading desks was one of measured optimism, with few signs of the kind of panic buying or excessive leverage that typically precedes sharp corrections. Wolfe Research strategist Chris Sinek reiterated that artificial intelligence remains the most dominant market theme driving investor sentiment and capital allocation decisions in 2026. Sinek noted that AI is no longer a speculative narrative but rather a structural shift that is reshaping revenue models, cost structures, and competitive dynamics across virtually every sector. The AI trade has expanded beyond pure-play chip makers and cloud providers to encompass enterprise software, cybersecurity, healthcare diagnostics, and even industrial automation companies. Institutional flows data shows record allocations to technology-focused exchange-traded funds, with AI-themed products seeing particularly strong inflows throughout April. Despite occasional rotation into value and defensive sectors, growth stocks have consistently reasserted their dominance, suggesting that the AI megatrend has deep roots in the current market cycle. Analysts caution, however, that the concentration of returns in a handful of megacap names remains a risk factor, as any earnings miss from a Magnificent Seven constituent could trigger an outsized market reaction. Subtopic 1a, AI-driven tech earnings propel the rally. Megacap technology earnings came in solid across the board, with the collective Magnificent Seven delivering aggregate revenue growth that exceeded consensus estimates by a meaningful margin. Chip makers were among the biggest beneficiaries of the AI wave, with Taiwan Semiconductor Manufacturing Company, TSMC, jumping 6.6% on record-breaking demand for advanced AI processors and high-bandwidth memory solutions. SK Hynix, South Korea's memory chip powerhouse surged an even more impressive 11% as its HBM, high-bandwidth memory, products continued to sell out at premium prices to hyperscale data center operators worldwide. The MSCI Asian Equities Index climbed 2.1%, advancing toward its all-time high and reflecting the global breadth of the AI-driven rally beyond U.S. borders. South Korea's KOSPI Index rose 4.26% on the week, its strongest weekly performance in over a year, driven almost entirely by semiconductor and memory chip names. The AI trade continues to dominate investor sentiment globally, with capital flowing aggressively into any company perceived to have a credible AI growth story. Market participants increasingly view the AI infrastructure build-out as a multi-year secular trend, comparable in scale to the mobile internet revolution of the 2010s. Topic 2. Federal Reserve Leadership Transition. Powell to Warsh. May 15, 2026, marks the final day of Jerome Powell's tenure as chair of the Federal Reserve, closing a consequential chapter in American monetary policy that spanned 2 presidential administrations, a global pandemic, and the most aggressive rate-hiking cycle in 4 decades. Kevin Warsh, a former Fed governor and Morgan Stanley executive, has been nominated by President Trump to succeed Powell and has outlined an ambitious agenda to fundamentally change the central bank's operational narrative. Warsh has signaled his intent to pursue radical balance sheet reduction, a departure from the gradual approach favored by Powell, which would represent one of the most significant shifts in Fed policy direction in recent memory. At the April 29 meeting, the Federal Open Market Committee, FOMC, held the federal funds rate steady at 3.50%, 3.75%, as expected, but the accompanying statement introduced new language acknowledging that Middle East developments are contributing to elevated economic uncertainty. Inflation remains stubbornly elevated at 3.5% as measured by the Personal Consumption Expenditures, PCE, index, well above the Fed's 2% long-run target. The decision was not unanimous. 3 FOMC members dissented, highlighting the growing divide within the committee over the appropriate path for interest rates in an environment of persistent inflation and geopolitical turmoil. The relationship between the White House and the Federal Reserve has been marked by unusually public tension throughout President Trump's tenure, with the president repeatedly feuding with Powell over the pace and direction of rate cuts. Trump has argued that high interest rates are unnecessarily restraining economic growth and has accused Powell of acting too slowly to ease monetary conditions, even as inflation has remained well above the central bank's target. Senator Thom Tillis played a pivotal role in clearing the path for Warsh's confirmation by helping resolve a Department of Justice probe related to Powell's conduct, removing a key procedural obstacle to the leadership transition. EY Parthenon economists expect Warsh to be confirmed by the Senate in time to chair the June FOMC meeting, which would make him the fastest confirmed Fed chair in modern history given the compressed timeline. Warsh's policy philosophy leans more hawkish on inflation and more skeptical of the Fed's post-2008 balance sheet expansion, suggesting that his tenure could bring a meaningful recalibration of the central bank's approach. Market participants are closely watching the transition for any signals about the Fed's independence and credibility under new leadership. The stakes of the leadership transition are particularly high given the complex and rapidly evolving macroeconomic environment facing the United States and the global economy. The Iran conflict has injected significant supply-side uncertainty into energy and commodity markets, complicating the Fed's inflation calculus and making the path of monetary policy even more dependent on unpredictable geopolitical developments. Warsh has publicly stated that he believes the Fed's balance sheet, which remains above $7 trillion, is too large and must be reduced more aggressively to restore the central bank's flexibility to respond to future crises. His approach could put downward pressure on Treasury prices and push long-term interest rates higher, with potentially significant implications for mortgage markets, corporate borrowing costs, and government debt servicing expenses. The confirmation process itself is expected to be contentious, with Senate Democrats likely to press Warsh on his views regarding Fed independence, his ties to Wall Street, and his willingness to resist political pressure from the White House. Regardless of the outcome, the transition from Powell to Warsh represents a generational shift in Federal Reserve leadership that will shape monetary policy for years to come. Subtopic 2a. The divided FOMC and rate policy outlook. 3 FOMC members dissented at the April 29 meeting, reflecting a committee that is increasingly fractured over the appropriate stance of monetary policy in the face of conflicting economic signals. Two of the dissenters favored an immediate rate cut, arguing that economic growth is slowing and the labor market is weakening in ways that warrant preemptive easing, while one dissenter opposed the committee's easing bias entirely, contending that inflation remains too high to justify any dovish pivot. The CME FedWatch tool currently shows a 100% probability that the Fed will hold rates unchanged at its next meeting, signaling that markets have fully priced in an extended pause. The federal funds rate stands at 3.50%, 3.75%, a level that many economists consider modestly restrictive but not sufficiently tight to bring inflation back to 2% quickly. The unemployment rate is 4.3%, and GDP growth registered 2% in the first quarter of 2026, painting a picture of an economy that is growing but losing momentum. The Fed's next scheduled policy meeting is June 16 to 17, which will likely be Warsh's first meeting as chair if his confirmation proceeds on schedule. Markets currently expect no rate cuts until at least late 2026, with some forecasters pushing their first cut expectations into early 2027. Topic 3. GameStop's $56 billion takeover bid for eBay. GameStop CEO Ryan Cohen submitted a non-binding proposal to acquire eBay at $125 per share, structured as 50% cash and 50% stock, in what would be one of the most audacious corporate takeover bids in recent memory. The deal values eBay at approximately $55.5 billion, representing a substantial premium to the company's pre-announcement market capitalization and reflecting Cohen's ambitious vision of creating a dominant e-commerce conglomerate. GameStop has quietly built a 5% stake in eBay over the preceding months, a strategic foothold that gives Cohen both leverage and credibility as he pursues a deal that many analysts initially dismissed as implausible. TD Bank has provided a highly confident letter committing to $20 billion in debt financing, a critical piece of the capital structure that demonstrates at least one major financial institution is willing to underwrite a significant portion of the transaction. GameStop currently holds $9.4 billion in cash reserves, a war chest that Cohen has been building methodically through a combination of secondary offerings, crypto investments, and aggressive cost-cutting at the company's legacy retail operations. Cohen has promised $2 billion in annual cost reductions within 12 months of deal completion, a synergy target that would require transformative operational restructuring across both organizations. The market reacted swiftly and dramatically to the announcement, with eBay shares jumping more than 13% in after-hours trading as investors priced in the possibility of a takeout premium, while GameStop shares rose approximately 4% on enthusiasm for Cohen's strategic boldness. The two companies share meaningful overlap in the collectibles, trading cards, and vintage goods categories, which Cohen views as the nucleus of a combined entity that could compete more effectively against Amazon's marketplace dominance. Cohen has publicly stated that his goal is to transform eBay into a legitimate Amazon competitor, combining GameStop's brand recognition among gaming and pop culture enthusiasts with eBay's massive global marketplace infrastructure and established seller base. Bloomberg intelligence analysts, however, have expressed skepticism about the deal's probability of completion, citing concerns about significant shareholder dilution, execution risk, and the enormous financing gap that would need to be bridged. The proposed transaction would require regulatory approvals from both U.S. and international antitrust authorities, adding another layer of complexity and uncertainty to an already challenging deal structure. Industry observers note that Cohen's track record of unconventional, high-conviction bets has yielded mixed results, making it difficult to predict whether this gambit will ultimately succeed or collapse under its own weight. The financial engineering required to close a deal of this magnitude would be unprecedented for a company of GameStop's size, as its current market capitalization of approximately $12 billion is roughly one-quarter of eBay's standalone value. Critics argue that the cash and stock structure would result in massive dilution for existing GameStop shareholders, potentially undermining the very stock price appreciation that Cohen's compensation package is designed to reward. Supporters counter that Cohen has repeatedly defied conventional wisdom throughout his career, from transforming Chewy into a pet e-commerce giant to engineering GameStop's pivot from a struggling brick-and-mortar retailer into a cash-rich holding company. The deal has energized GameStop's retail investor base, which has long viewed Cohen as a visionary leader capable of executing unconventional strategies that traditional Wall Street analysts fail to appreciate. If eBay's board rejects the proposal, Cohen has indicated he is prepared to pursue a proxy fight to force the issue, leveraging GameStop's 5% ownership stake and the support of sympathetic institutional investors. The coming weeks will determine whether this proposal evolves from an audacious bid into a transformative transaction or fades into the long list of ambitious mergers that never materialized. Subtopic 3a, Cohen's strategic vision and market skepticism. Ryan Cohen has overseen a dramatic transformation at GameStop, shrinking the company's workforce from 14,000 employees in 2020 to approximately 4,000 in 2026, reflecting his relentless focus on operational efficiency and his willingness to make difficult structural decisions. His compensation package is explicitly designed to reward transformative growth, with significant equity incentives that vest only if GameStop achieves a $100 billion market capitalization, a threshold that would require either extraordinary organic growth or a game-changing acquisition. eBay, for its part, brings 135 million active buyers globally who collectively spend approximately $80 billion annually on the platform, a user base and transaction volume that would instantly catapult the combined entity into a different competitive tier. The size mismatch is stark. GameStop's market capitalization of $12 billion stands in sharp contrast to eBay's approximately $46 billion valuation, making this effectively a reverse takeover in which the smaller company would absorb the larger one. Bernstein analysts have noted that eBay is currently in the midst of its own turnaround effort under CEO Jamie Iannone, raising questions about whether a hostile bid would be welcome or whether it might actually disrupt positive momentum already underway. The financing gap, the difference between committed debt, available cash, and the total deal value remains the single biggest question mark hanging over the proposal, and filling it would likely require additional equity issuance that could dilute existing shareholders significantly. Cohen has stated publicly that he is prepared for a proxy fight if eBay's board resists the proposal, signaling that he views this as a defining moment in both his career and GameStop's evolution as a company. Topic 4. U.S. national debt surpasses the entire economy. In a grim fiscal milestone, the U.S. public debt held by the public reached $31.27 trillion as of March 31, 2026, officially surpassing the nation's nominal gross domestic product of $31.22 trillion and pushing the debt-to-GDP ratio above 100% for the first time since the immediate aftermath of World War II in 1946. The gross national debt, which includes both publicly held debt and intragovernmental holdings, stands at approximately $38.95 trillion, representing more than 120% of GDP and continuing to climb with no meaningful fiscal consolidation plan on the horizon. The Congressional Budget Office, CBO, projects that the debt-to-GDP ratio will reach 120% by 2036 and an alarming 175% by 2056 under current law, a trajectory that would put the United States in the company of the most heavily indebted nations in the developed world. Interest payments on the national debt now consume 14% of all federal spending, meaning that more than $1 in every $7 the government spends goes simply to servicing past borrowing rather than funding current programs or investments. The fiscal year 2026 deficit already stands at $1.17 trillion through March, with full-year projections approaching $2 trillion, reflecting both the structural imbalance between revenues and expenditures and the rising cost of servicing existing debt at elevated interest rates. The Committee for a Responsible Federal Budget, CRFB, President Maya McGuinness characterized the situation as a total bipartisan abdication of making hard choices, noting that neither political party has demonstrated the willingness to propose or enact the difficult spending cuts and revenue increases necessary to change the fiscal trajectory. The federal government currently spends $1.33 for every dollar it collects in revenue, a gap that has persisted and widened across multiple administrations of both parties, driven by rising mandatory spending obligations and a political culture that rewards fiscal expansion over restraint. The three largest drivers of the growing debt are Social Security, Medicare, and interest payments, all of which are on autopilot growth trajectories that will accelerate as the baby boomer generation ages further into retirement and as higher interest rates increase the cost of rolling over existing obligations. The political incentive structure makes meaningful fiscal reform extraordinarily difficult, as any proposal to cut benefits or raise taxes faces immediate and intense opposition from well-organized constituencies on both sides of the aisle. Economists across the ideological spectrum have warned that the current path is unsustainable, but the timeline of consequences remains hotly debated, with some arguing that a crisis is decades away while others see growing fragility in the Treasury market. The implications for ordinary Americans are real and growing, as higher government borrowing crowds out private investment, puts upward pressure on interest rates, and limits the government's fiscal capacity to respond to future recessions, pandemics, or national security emergencies. The structural nature of the fiscal challenge is particularly concerning because the fastest growing components of federal spending, Social Security, Medicare, Medicaid, and debt service, are largely insulated from the annual appropriations process and grow automatically under current law. Discretionary spending, which includes defense, education, infrastructure, and scientific research, accounts for a shrinking share of the overall budget, meaning that the government's ability to invest in the future is being progressively squeezed by obligations incurred in the past. The CRFP has proposed a 3% of GDP deficit target as a framework for stabilizing the debt, but current deficits are running at approximately 6% of GDP and are projected to grow toward 7% by the end of the decade, making even the stabilization target appear ambitious. Credit rating agencies have already downgraded or placed on negative watch U.S. sovereign debt, citing what Fitch described as a long-running deterioration in fiscal governance and the repeated use of debt ceiling brinksmanship as a political weapon. Higher debt levels translate directly into higher mortgage rates, costlier auto and student loans, and more squeezed government spending on the programs and services that Americans depend on daily. The question facing policymakers is not whether the debt trajectory is a problem, but whether the political system is capable of addressing it before markets force a more painful and disruptive adjustment. Topic 5. Oil prices and the Strait of Hormuz crisis. The Iran conflict, which escalated dramatically beginning in late February 2026, has triggered what the International Energy Agency, IEA, describes as the largest oil supply disruption on record, removing approximately 10 million barrels per day from global production and transit capacity at the peak of hostilities. Brent crude surged above $120 per barrel during the most acute phase of the crisis, as fears of a complete closure of the Strait of Hormuz, the narrow waterway through which 35% of global seaborne crude oil and 20% of the world's liquefied natural gas, LNG, trade flows, sent shockwaves through energy markets worldwide. The World Bank forecasts that Brent will average $86 per barrel in 2026, up sharply from $69 in 2025, though the range of uncertainty around that forecast remains exceptionally wide given the ongoing and unpredictable nature of the conflict. Energy prices overall are projected to rise 24% in 2026, representing the single largest year-over-year increase since 2022 and posing a significant headwind for global economic growth, corporate profit margins, and consumer purchasing power. The United Arab Emirates' decision to leave OPEC during the crisis further destabilized the cartel's ability to manage supply, dropping OPEC's share of global oil production from 37% to 28% and raising questions about the organization's long-term relevance and cohesion. OPEC Plus is structurally weakened by the conflict dynamics, as member states' competing geopolitical interests and divergent fiscal needs have made coordinated production decisions increasingly difficult to achieve and sustain. The disruption to Middle Eastern oil production and transit routes has sent ripple effects across every corner of the global economy, from shipping insurance premiums that have skyrocketed for vessels transiting the Persian Gulf to refinery margins that have widened dramatically in regions dependent on Middle Eastern crude feedstocks. Asian economies, particularly China, Japan, South Korea, and India, are especially vulnerable given their heavy reliance on Middle Eastern crude oil imports, and the crisis has accelerated efforts by these nations to diversify their energy supply chains and invest in domestic renewable energy capacity. The U.S., while better positioned than most due to its domestic shale production base, has not been immune to the effects, as higher global oil prices have filtered through into gasoline, diesel, and jet fuel costs that affect transportation, logistics, and ultimately consumer prices. Strategic petroleum reserve releases by the U.S. and other IEA member nations have provided some temporary relief, but reserves are at historically low levels following the drawdowns of 2022 to 2023, limiting the scope for further intervention. The crisis has also reignited the debate over energy security and the pace of the global energy transition, with fossil fuel advocates arguing that the conflict demonstrates the continued indispensability of hydrocarbon production, while clean energy proponents contend that it underscores the urgent need to reduce dependence on geopolitically volatile supply chains. Market volatility in the energy sector is expected to remain elevated for the foreseeable future, with Brent crude options markets pricing in an unusually wide range of outcomes through year-end. The geopolitical dimensions of the oil crisis extend well beyond the immediate supply disruption, as the conflict has reshaped alliances, strained diplomatic relationships, and created new fault lines in the global energy order. The UAE's departure from OPEC, in particular, represents a tectonic shift in the cartel's structure and raises fundamental questions about whether the organization can continue to function as an effective price-setting mechanism without one of its most productive and strategically important members. Saudi Arabia, which has assumed the role of swing producer within the diminished cartel, faces the difficult task of balancing its desire for higher oil revenues against the risk that sustained high prices will accelerate demand destruction and investment in alternative energy sources. Russia, already grappling with sanctions and declining production from mature fields, has found its leverage within OPEC Plus further diminished by the conflict's disruption to traditional power dynamics. The insurance and shipping industries have been among the most directly affected, with war risk premiums for vessels transiting the Strait of Hormuz reaching levels not seen since the tanker war of the 1980s. The broader implications for global inflation, trade flows, and economic growth will take months to fully manifest, but the consensus among economists is that the Hormuz crisis has added at least 0.5 to 1.0 percentage points to global inflation forecasts for 2026. Subtopic 5a, Global Commodity Cascade and Inflation Pressure. The energy shock has cascaded across the entire commodity complex, with fertilizer prices projected to rise 31% in 2026 and urea, a key nitrogen fertilizer, surging an astonishing 60% as natural gas feedstock costs and Middle Eastern production disruptions compound existing supply constraints. The World Food Programme, WFP, has warned that up to 45 million additional people could face acute food insecurity as a result of the energy-driven commodity price shock, with the most severe impacts expected in sub-Saharan Africa, South Asia, and the Middle East itself. Base metals including aluminum, copper, and tin are expected to hit all-time highs in 2026, driven by a combination of supply disruptions, elevated energy input costs, and persistent demand from the global AI infrastructure build-out and green energy transition. Precious metals are forecast to rise 42% on the year, with gold projected to average $4,700 per ounce as investors flock to safe haven assets amid geopolitical uncertainty, persistent inflation, and growing concerns about the sustainability of sovereign debt trajectories. Overall commodity prices are forecast to rise 16% in 2026, representing the broadest and most sustained commodity price increase since the commodity supercycle of the early 2010s. The World Bank has warned of cumulative waves of economic disruption hitting the global economy, as higher energy costs feed through to transportation, manufacturing, agriculture, and ultimately consumer prices with varying and often unpredictable time lags. Asian economies are particularly vulnerable due to their heavy dependence on Middle Eastern oil imports and their exposure to global commodity supply chains, raising the prospect of a synchronized slowdown across the region's largest economies. Topic 6. Bitcoin and cryptocurrency market update. Bitcoin is currently trading in the range of $78,500 to $79,000, having surged past the $79,000 level on the back of escalating U.S. Iran geopolitical tensions that have driven safe haven demand and speculative interest in digital assets. The total cryptocurrency market capitalization stands at approximately $2.6 trillion, reflecting steady recovery and growth from the bear market lows of 2022 to 2023 and renewed institutional confidence in the asset class. Bitcoin spot ETFs recorded $630 million in net inflows on May 1 alone, bringing total recent inflows to approximately $1.9 billion over the preceding week and underscoring the transformative impact that regulated exchange-traded products have had on the accessibility and legitimacy of cryptocurrency investing. Total Bitcoin ETF assets under management have now surpassed $100 billion, a milestone that was widely considered unachievable just 2 years ago and that has cemented Bitcoin's status as a mainstream institutional asset class. Ethereum spot ETFs also saw meaningful activity, recording $101 million in net inflows on May 1, signaling that institutional demand is broadening beyond Bitcoin to include the second largest cryptocurrency by market capitalization. Dormant wallets containing Bitcoin that had not moved in years transferred 793 BTC, valued at approximately $62.5 million, between May 1 and May 3, a development that on-chain analysts are monitoring for potential signals about the intentions of early Bitcoin holders. The U.S. Senate released the text of the Clarity Act compromise legislation on May 3, providing a regulatory tailwind that crypto market participants have been anticipating for months. The bill aims to establish a clear regulatory framework for digital assets, delineating the respective jurisdictions of the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, and providing legal certainty that industry leaders have long argued is essential for institutional adoption at scale. April was Bitcoin's strongest month of 2026, with the cryptocurrency rising 11.87% and outperforming most traditional asset classes over the same period. However, seasonal headwinds loom, as historical data shows that May has frequently closed in the red for Bitcoin, lending some credence to the old Wall Street adage of, sell in May and go away. The regulatory clarity provided by the Clarity Act, if it advances through Congress and is signed into law, could provide a structural catalyst that overrides seasonal weakness and establishes a new floor for crypto valuations. Market structure indicators suggest that the rally has been driven primarily by spot buying rather than leveraged speculation, which analysts generally view as a healthier and more sustainable foundation for further price appreciation. The broader cryptocurrency ecosystem continues to mature and diversify, with developments across multiple blockchains, tokens, and use cases attracting attention from both retail and institutional participants. Solana remains under close observation for its rapid ecosystem expansion and the growing possibility of a Solana spot ETF approval, which could unlock a new wave of institutional capital for the high-performance Layer 1 blockchain. XRP continues to attract attention for its cross-border payment utility and its ongoing legal clarity following the resolution of key regulatory disputes in prior years. Dogecoin delivered its best monthly performance in 9 months during April, driven by renewed retail enthusiasm and social media momentum that has become a recurring feature of the crypto market landscape. The funding rate for Bitcoin perpetual futures sits at 0.0006%. An extremely low level that suggests the market is not excessively leveraged in either direction. Notably, 89% of recent liquidations have hit short positions, indicating that bearish traders have been caught offside by the strength of the rally and forced to cover their positions at a loss. The combination of regulatory progress, strong ETF inflows, and improving market structure paints a cautiously optimistic picture for the cryptocurrency market heading into the summer months. Subtopic 6a. Institutional versus retail dynamics in crypto. BlackRock's iShares Bitcoin Trust, IBIT, led all Bitcoin ETF products with $284.4 million in net inflows on May 1, further consolidating its position as the dominant institutional vehicle for regulated Bitcoin exposure. In contrast, Invesco's BTCO product saw $4.94 million in net outflows on the same day, illustrating the uneven distribution of institutional demand across the growing universe of Bitcoin ETF products. Market analysts interpret these divergent flows as evidence that capital is rotating between fund managers rather than entering the crypto market uniformly, with investors increasingly gravitating toward the largest, most liquid, and most established ETF products. Solana is under observation for ecosystem expansion and potential spot ETF approval, which could represent the next major catalyst for broadening institutional access to alternative Layer 1 blockchains. XRP continues attracting attention for its cross-border payment use case, with enterprise adoption metrics showing steady growth in transaction volumes processed through RippleNet. Dogecoin delivered its best monthly performance in 9 months, rising sharply in April on a combination of retail speculation and renewed social media activity that has made the meme coin a persistent feature of the crypto landscape. The funding rate sits at a neutral 0.0006%, with 89% of liquidations hitting short positions, suggesting that bearish traders have been systematically squeezed out of the market during the recent rally. Topic 7. Magnificent 7 and AI trade dominance. Strong first-quarter earnings from the Magnificent 7 megacap technology companies drove global equity markets higher during the final trading sessions of April and into early May, reinforcing the central role that these 7 companies play in the broader market narrative. The MSCI Asian Equities Index climbed 2.1% on the week, advancing toward its all-time high set on February 27, as the positive sentiment generated by U.S. tech earnings spilled over into international markets with significant technology exposure. Taiwan Semiconductor Manufacturing Company, TSMC, jumped 6.6% as its quarterly results revealed surging demand for advanced chips used in AI training and inference workloads, confirming that the semiconductor upcycle remains in its early stages. SK Hynix surged 11%, making it one of the best-performing large-cap stocks globally during the week, as orders for its high-bandwidth memory, HBM, products continued to outstrip even the company's most optimistic capacity expansion plans. South Korean and Taiwanese equity markets both advanced more than 4.5% on the week, driven almost entirely by the performance of their respective semiconductor sectors and the global investor enthusiasm for any company with meaningful AI exposure. The concentration of market gains in AI-adjacent names has raised questions about the sustainability of the rally, but for now, the earnings fundamentals continue to support the narrative. Wolfe Research's Chris Seinick has consistently argued throughout 2026 that artificial intelligence remains the single most dominant theme driving investor sentiment, capital allocation, and stock selection decisions across the global equity landscape. The AI narrative has evolved from a speculative concept focused on chatbots and language models into a broad-based industrial theme that encompasses data center construction, power grid infrastructure, semiconductor manufacturing capacity, enterprise software transformation, and even drug discovery and materials science. Investors continue to chase perceived winners in the semiconductor and memory chip segments of the AI value chain, where companies like NVIDIA, TSMC, SK Hynix, and ASML have delivered earnings growth rates that dwarf those of the broader market. The scale of capital expenditure planned by hyperscale cloud providers including Microsoft, Amazon, Google, and Meta for AI infrastructure in 2026 and 2027 has reached levels that were almost inconceivable just 2 years ago, providing multi-year revenue visibility for the entire AI supply chain. This visibility has given institutional investors the confidence to maintain and even increase their allocations to AI-exposed equities despite valuations that, by historical standards, appear stretched. The AI trade is arguably the single most powerful force in global equities right now, shaping not only the direction of major stock indexes but also the flow of venture capital, corporate strategy, and government industrial policy worldwide. The global nature of the AI rally is a distinguishing feature of this market cycle, as the investment opportunity spans multiple geographies, currencies, and market structures in ways that previous technology waves did not. Asian markets, particularly in South Korea, Taiwan, and Japan, have been primary beneficiaries due to their deep bench of semiconductor and electronic component manufacturers, while European markets have lagged as the region lacks comparably scaled AI infrastructure companies. The breadth of the AI theme has also attracted attention from traditionally non-tech-focused investors, including sovereign wealth funds, pension systems, and endowments, who view AI infrastructure as a multi-decade secular growth opportunity analogous to the build-out of the Internet in the 1990s and 2000s. However, the concentration of returns in a relatively small number of mega-cap names remains a source of concern for market strategists who worry about the systemic risk implications of portfolio crowding and the potential for a sharp correction if any of the leading companies report a meaningful earnings shortfall. Some analysts have drawn parallels to the dot-com era, though they are quick to note that today's AI leaders are generating enormous actual cash flows and earnings, unlike many of the speculative internet companies of the late 1990s. The consensus view on Wall Street remains that the AI megatrend has significant runway ahead, but selectivity and risk management are becoming increasingly important as the cycle matures and valuation dispersion widens. Topic 8. Trump's Project Freedom for the Strait of Hormuz. President Trump announced Project Freedom, a U.S.-led initiative aimed at guiding stranded commercial vessels from neutral and innocent countries out of the Strait of Hormuz, which has been effectively blockaded during the ongoing Iran conflict. Trump described the plan as a humanitarian gesture undertaken on behalf of the United States and its Middle Eastern allies, framing it as a demonstration of American naval power and diplomatic leadership in a region convulsed by war. The announcement drew mixed reactions from investors and geopolitical analysts, with many expressing skepticism about the plan's operational feasibility and questioning whether it represents a genuine de-escalation strategy or merely a public relations exercise designed for domestic political consumption. Oil prices fell slightly following the announcement, suggesting that energy markets interpreted the initiative as marginally positive for supply but far from a definitive resolution to the underlying conflict driving the crisis. South Korean stocks hit fresh records amid the news, as investors in export-dependent Asian economies latched onto any signal that the crisis might be moving toward resolution and that shipping lanes could be gradually reopened. Trump simultaneously hinted at positive developments in Iran negotiations while casting public doubts on a specific Iranian peace proposal, sending characteristically mixed signals that left markets uncertain about the true trajectory of diplomatic efforts. The practical challenges of implementing Project Freedom are formidable, as the Strait of Hormuz is one of the most heavily militarized waterways in the world, and any attempt to escort commercial shipping through contested waters carries significant risks of miscalculation or escalation. The U.S. Navy's Fifth Fleet, headquartered in Bahrain, has the operational capability to provide escort services, but doing so on a sustained basis would require a significant commitment of naval resources that could strain other commitments in the Pacific and elsewhere. Insurance companies, which have dramatically increased war risk premiums for vessels transiting the Persian Gulf, would need to assess whether the presence of U.S. naval escorts meaningfully reduces the risk profile for commercial shipping, a determination that could take weeks or months to formalize. Prediction markets and geopolitical risk consultancies remain cautious about the plan's effectiveness, noting that previous U.S. escort operations in the Persian Gulf, including during the 1987 to 1988 tanker war, were complex, costly, and produced mixed results. The international community has offered qualified support for the concept while stopping short of committing military assets to the effort, reflecting the diplomatic delicacy of operating in a war zone where the interests of multiple major powers intersect and conflict. The ultimate test of Project Freedom will be whether it can meaningfully increase the volume of oil and LNG transiting the strait, a metric that will be closely watched by energy markets in the coming weeks. The diplomatic dimensions of the Hormuz crisis are at least as complex as the military ones, as the United States seeks to navigate competing pressures from allies in the Gulf, European partners pushing for a negotiated settlement, and domestic political imperatives ahead of the 2026 midterm elections. Trump's statement that Iran was making a deal because they have no military left was viewed by diplomatic observers as inflammatory and potentially counterproductive, as it could harden Iranian resolve and complicate the work of negotiators seeking to de-escalate the situation through back-channel communications. The United Nations has condemned the violence and called for an immediate ceasefire, but the Security Council has been unable to pass a binding resolution due to vetoes from permanent members with conflicting interests in the region. Any meaningful resolution of the crisis could dramatically reshape global energy markets and inflation trajectories, potentially removing the single largest source of uncertainty currently weighing on the global economic outlook. Conversely, a failure of diplomatic efforts or an escalation of hostilities could push oil prices back above $120 per barrel and trigger a global recession that central banks would have limited tools to combat. The stakes could hardly be higher, and the coming weeks will be critical in determining whether Project Freedom represents a genuine path toward stability or merely another chapter in a long and volatile conflict. Subtopic 8a, Market Reaction and Diplomatic Uncertainty. Investors are closely monitoring whether Project Freedom can meaningfully reopen shipping lanes and restore a measure of normalcy to global energy supply chains that have been severely disrupted since late February. Early Monday futures trading showed S&P 500 futures adding 0.11% and Nasdaq 100 futures adding 0.33%, reflecting cautious optimism that the initiative could gradually ease the supply constraints that have driven energy prices sharply higher. However, Dow futures fell 48 points, dragged lower by energy and industrial stocks that would benefit less from a normalization of oil prices and more from a continuation of the elevated price environment. The overall market reaction suggests cautious optimism mixed with deep skepticism, as investors have learned through experience to discount the gap between presidential announcements and actual policy implementation in geopolitically complex environments. Trump's assertion that Iran was making a deal because they have no military left struck many analysts as premature and potentially destabilizing, as it could complicate ongoing behind-the-scenes negotiations by hardening the Iranian regime's public posture. The United Nations has condemned the violence and called for restraint from all parties, but concrete diplomatic progress remains elusive as competing interests among major powers continue to frustrate multilateral efforts at de-escalation. Any genuine resolution of the Hormuz crisis could dramatically reshape energy markets and global inflation trajectories, potentially removing the single largest source of macroeconomic uncertainty confronting investors worldwide. Topic 9. April Jobs Report Preview and Labor Market Outlook. The April Jobs Report, scheduled for release on Friday, May 8, at 8:30 a.m. Eastern Time, is expected to show a significant deceleration in hiring activity, with the Dow Jones Consensus Estimate calling for just 53,000 non-farm payroll additions, far below March's blowout figure of 178,000 and well below the monthly average that would be consistent with a healthy, expanding labor market. The unemployment rate is expected to hold steady at 4.3%, a level that is elevated compared to the sub-4% readings that prevailed through much of 2022 and 2023, but still within the range that the Federal Reserve considers broadly consistent with maximum employment. The information technology sector has been a particularly notable source of weakness, having shed more than 300,000 jobs since 2022 as companies have implemented cost-cutting measures, restructured operations around AI-driven efficiency gains, and shifted investment from personnel to technology infrastructure. The labor market is stagnating amid a confluence of headwinds, including geopolitical uncertainty related to the Iran conflict, elevated inflation that is squeezing consumer spending power, and tighter financial conditions resulting from the Fed's extended pause at restrictive interest rate levels. First quarter GDP growth came in at 2%, a pace that the Fed described as solid but that is noticeably slower than the 2.8% growth rate recorded in 2024, suggesting that the economy is gradually losing momentum. The Fed's April statement acknowledged that job gains have remained low on average, a notable shift in language from earlier in the year when the committee had described the labor market as strong and resilient. This linguistic evolution reflects the accumulating evidence that the labor market, while not in recession, is cooling in ways that warrant close attention from policymakers. Initial jobless claims have edged higher in recent weeks, and the ratio of job openings to unemployed workers has declined from its pandemic-era peak of nearly 2:1 to approximately 1.1:1, indicating that the excess demand for labor that characterized the post-pandemic recovery has largely dissipated. The composition of job growth has also shifted, with gains increasingly concentrated in healthcare, government, and leisure and hospitality, while manufacturing, construction, and professional services have stagnated or contracted. Wage growth, while still positive in nominal terms, has decelerated to a pace that is barely keeping up with inflation, eroding the purchasing power gains that workers had experienced earlier in the recovery. The labor market dynamics are creating a challenging environment for the Federal Reserve, which must balance the risk of waiting too long to cut rates and allowing the labor market to deteriorate further against the risk of cutting too soon and reigniting inflationary pressures that have proven stubbornly persistent. For investors, the April jobs report will be closely scrutinized for signals about the trajectory of the economy and the likely path of Federal Reserve policy over the remainder of 2026. A significantly weaker than expected report could revive expectations for rate cuts later in the year, providing a tailwind for both equity and fixed income markets, while a stronger than expected report would likely reinforce the higher for longer narrative that has dominated market pricing. The report will also provide important context for the incoming Fed Chair, Kevin Warsh, who will need to quickly assess the state of the labor market as he prepares to lead his first FOMC meeting in June. Sector-level details will be particularly important, as investors look for signs of whether the AI-driven restructuring of the technology workforce is accelerating, stabilizing, or beginning to reverse as companies move from the cost-cutting phase to the growth investment phase of the AI cycle. Average hourly earnings data will also be closely watched, as any reacceleration in wage growth could complicate the inflation outlook and reinforce the Fed's reluctance to ease monetary policy. The combination of a potentially soft headline number and persistent wage pressures could present a Goldilocks scenario for equity markets, weak enough to keep rate cut hopes alive but not so weak as to signal an imminent recession. Topic 10. Interest on U.S. debt becoming a top deficit driver. Federal interest expense has now surpassed defense spending as a share of the budget, a milestone that underscores the extent to which past borrowing decisions are constraining the government's fiscal flexibility and crowding out investment in other national priorities. The sheer scale of accumulated debt now exceeding the size of the entire U.S. economy means that even modest increases in interest rates translate into tens of billions of dollars in additional annual interest costs, creating a self-reinforcing dynamic in which higher debt leads to higher interest expense, which leads to larger deficits, which leads to even more debt. In what economists describe as a fiscal dominance regime, The Federal Reserve's ability to use interest rate hikes as a tool to combat inflation is fundamentally constrained, because raising rates sharply enough to bring inflation to target could push interest costs on the national debt to levels that trigger a fiscal or financial crisis. This dynamic creates a tension between the Fed's price stability mandate and the government's need to borrow at affordable rates, a tension that is likely to intensify under the incoming Warsh chairmanship as the new Fed leader attempts to implement his agenda of aggressive balance sheet reduction. Rating agencies including Moody's, S&P, and Fitch have all expressed concern about the long-running deterioration in U.S. fiscal governance, noting that repeated episodes of debt ceiling brinksmanship, partisan gridlock over budget priorities, and the absence of a credible long-term fiscal plan have eroded confidence in the government's willingness to address its structural fiscal imbalance. America's debt has just surpassed the size of its entire economy, and the trajectory points unmistakably upward. The Committee for a Responsible Federal Budget has proposed a deficit target of 3% of GDP as a framework for stabilizing the debt-to-GDP ratio over the medium term, but current deficits are running at approximately 6% of GDP and are projected to grow toward 7% by the end of the decade. Closing a gap of that magnitude would require a combination of spending cuts and revenue increases totaling roughly $1 trillion per year, a scale of fiscal adjustment that has no precedent in peacetime American history and that faces nearly insurmountable political obstacles. The three largest mandatory spending programs, Social Security, Medicare, and Medicaid, are projected to grow faster than the economy for as far as the CBO's projections extend, driven by demographic forces that are essentially irreversible and by healthcare cost trends that have proven resistant to reform efforts across multiple administrations. Interest payments, which are now the fastest growing component of federal spending, are projected to consume an even larger share of the budget in coming years as existing debt is rolled over at higher interest rates and new borrowing continues at a pace that far exceeds historical norms. The consequences for ordinary Americans are tangible and growing. Higher government borrowing pushes up interest rates across the economy, making mortgages, auto loans, student loans, and credit card balances more expensive for households and businesses alike. The fiscal trajectory also limits the government's capacity to respond to future crises, whether economic recessions, natural disasters, pandemics, or national security emergencies, because the fiscal space that would normally be available for counter-cyclical spending has been consumed by structural deficits accumulated during periods of relative prosperity. The intersection of fiscal policy and monetary policy is becoming one of the most important and complex challenges facing American economic governance, as the constraints imposed by the debt trajectory increasingly limit the options available to both Congress and the Federal Reserve. Historically, the U.S. has been able to borrow at relatively low rates because of the dollar's status as the world's reserve currency and the deep liquidity and perceived safety of treasury markets, but there are growing signs that these advantages are eroding at the margin as foreign central banks gradually diversify their reserve holdings and as the supply of treasury securities outpaces demand growth. The potential consequences of a loss of confidence in U.S. fiscal sustainability, while still considered a tail risk by most economists, would be catastrophic, as a sharp increase in Treasury yields could trigger cascading effects through the financial system, from bank balance sheets to pension fund solvency to the housing market. The CRFB and other fiscal watchdog organizations have argued that the window for proactive fiscal reform is closing, and that the longer policymakers wait to address the structural imbalance, the more painful and disruptive the eventual adjustment will be. Current deficits approaching 6% of GDP and growing toward 7% by decade's end represent a pace of borrowing that is simply unsustainable over the medium to long term, regardless of the dollar's reserve currency status. The fundamental question confronting the nation is whether democratic governance can summon the political will to make difficult fiscal choices before markets impose those choices through a crisis. Subtopic 10A, the Blue Economy and Alternative Investment Frontiers. Investors and scientists are increasingly viewing the world's oceans as an asset class worth protecting and investing in, with the emerging blue economy gaining traction as a legitimate and growing investment category that spans sustainable fisheries, marine biotechnology, ocean-based renewable energy, and coastal resilience infrastructure. The blue economy is gaining traction precisely because it sits at the intersection of environmental sustainability, economic growth, and climate adaptation, three themes that are increasingly central to institutional investment mandates and government policy priorities worldwide. Mackenzie Scott's philanthropic strategy, which has directed billions of dollars toward innovative and often overlooked organizations working on environmental and social challenges, is being cited by impact investors as a model for smarter capital allocation that prioritizes scalability and measurable outcomes over traditional philanthropic approaches. The investor community is actively working to figure out how to scale blue economy investments quickly, with several major asset managers launching dedicated ocean-focused funds and working with multilateral development banks to create blended finance structures that de-risk private capital deployment in frontier markets. This emerging asset class represents a potential diversification play away from traditional debt-heavy markets, offering return profiles that are uncorrelated with conventional fixed income and equity investments and that carry the additional appeal of positive environmental and social impact. Sustainable finance is growing as a counter-narrative to the fiscal deterioration dominating headlines, providing a framework for investors who want to generate competitive returns while contributing to solutions for some of the world's most pressing challenges. Forward-looking investors are watching this space closely for opportunities, recognizing that the blue economy, while still in its early stages, has the potential to become a significant component of diversified institutional portfolios over the coming decade. Video tags. YouTube tags copy and paste. Finance news today, stock market news, S&P 500 all-time high,